Welcome to another episode of A Quest for Twice. Today, I'm going to cover earning reports from several companies in my portfolio. The first one is JFrog. JFrog reported very strong earning in the recent quarter. So we can see in the bar chart on the right, its quarterly revenue grew basically sequentially every quarter since third quarter of 2019. Now it's estimated the Q3 revenue will be about $71 million. That's almost double as about 2 years ago. JFrog also raised its full year revenue guidance to $280 million, up from $274 million given previously. Its trailing 12-month net dollar retention rate is at 132%. It's actually up from 130% reported the last quarter. At $25 per share, its duration to parity is 7.2, which is fairly reasonable for a software company. So can its fast growth continue? The key is the adoption of its Enterprise Plus product. So in the latest quarter, that's 36% of its total revenue translates into $24.4 million. That's up 50% from second quarter of last year. Its revenue from other products was $43.4 million in the most recent quarter. That's up about 30%. Although the Enterprise Plus product revenue is less than the other products revenue, it's growing faster. So eventually it's going to overtake the other products revenue. Because the Enterprise Plus is a complete product suite, it will make it much harder for its customers to switch to its competitors. Therefore, that's a very strong sign of building a moat around its key products. As a result, its revenue growth can continue. On the other hand, Upstart reported dismal second quarter revenue and also gave disappointing guidance for the third quarter revenue around $170 million. So if we look at the revenue in the last 8 to 10 quarters, the most recent quarter plus third quarter revenue is actually going in the wrong way. That's reflected in the transaction volume as well. The transaction of $3.3 billion in Q2 was less than $4.5 billion in the first quarter, and just not that much more than the $2.8 billion in transaction revenue in 1 year ago. The main reason for the revenue decline is because of the very fast rising interest rate. As a result, many financial institutions who normally buy Upstart loans are pulling back. So they are not providing the funding Upstart needed them to lend to the borrowers. Upstart is a victim of the current rising interest rate environment. Let's look at its growth drivers. The most recent quarter had a conversion rate of 13.3%. That's significantly lower than the conversion rates in the previous several quarters. It's even lower than in Q3 2020. Keep in mind that Q3 2020 was when the pandemic was still ongoing. There were a lot of uncertainties about the economy, about the vaccine. So 13.3% conversion rate reflects a very low conversion, and that's because of the supply of funding is much less than the demand of the borrowers. The good news is Its auto product rollout is continuing in the Q2 of 2022. There were about 640 auto dealers using Upstart's auto sales software. So that shows its growth initiative in the auto loan market is still intact. Now it's time to update the threats and opportunities. A new threat is Upstart may use its own funds to make the loans, which creates a credit risk exposure. Amazon also reported the latest quarterly earnings. Its trailing 3-month underlying orders is holding steady at 10% in June. The commercial and residential solutions order book grew by 5%, while automation solutions grew 13% compared 1 year ago. That's not surprising given the cooling housing market. Amazon also updated the guidance for the full year. Now the net sales growth is forecasted to grow 7 to 8% compared to previous guidance about 8 to 10%. That's driven by the slower growth in the automation solutions compared to previous guidance. However, it actually raised its earning per share to about $5.30 compared to previous guidance of $4.85. So why is EPS up while sales is guided down? That's because of the merger with AspenTech on May the 16th for about $6 billion. So the Aspen business is going to contribute to the EPS. AspenTech also contributed about 150 bips to EBITDA margin. The automation solution backlog is at $6.2 billion. That's down $0.4 billion Q on Q, mostly because of the impact from Russia business and AspenTech. Its commercial residential solution backlog is at $1.3 billion. No change from previous quarter. Sales increase as well as the EPS guidance reflects the strength of Amazon's mode. It has a pricing power, can pass the cost increase onto its customers. Walker Dunlop also reported a strong quarter. Its second quarter transaction volume was 22.5 billion compared to 13.6 billion 1 year ago. Its servicing portfolio stands at $119 billion at the end of June compared to $116 billion at the end of March. So very little change. Its business highlight is property sales. So in the first quarter, sales volume was 3.5 billion. That's more than double of the sales volume 1 year ago. And in the second quarter, its sales volume was 7.9 billion. Again, more than double of the volume 1 year ago. That's despite the interest rate rises and pullback by market participants. So those are very impressive numbers. Let's take a look at its quarterly revenue makeup. Its loan origination and debt brokerage fee actually contracted by about 45% compared to 1 year ago. That's because its mix of products is not as profitable as 1 year ago. Its additional value of mortgage service right grew less compared to 1 year ago. That's also because of the government-sponsored enterprises were pulling back in the first half of this year. The bright spot is the property sales commission, $46 million. That's more than double of the commission it received 1 year ago. Its investment management fees came in at over $10 million compared to $3.8 million 1 year ago. That's because of the portfolio brought in from the acquisition of Align Capital. The escrow earnings and other interests also jumped up to $6.7 million compared to $1.8 million 1 year ago. That's because of the significantly higher interest rate. So that's a natural hedge on its business because higher interest rate increased the interest revenue on its escrow account. On the other hand, the higher interest rate depress the market participation and reduce its loan origination and debt brokerage fees. Lastly, its other revenue, including consulting fee, increased to $43 million compared to $10 million 1 year ago. That's because of the significant contribution from Zelman and Align acquisitions. Looking at the expenses, the biggest expense is personnel expense. That's almost 50% of the revenue at $168 million compared to $141 million 1 year ago. That increase was driven by acquisitions of new companies. Its interest expense on corporate debt also increased to $6.4 million compared to $1.76 1 year ago. That's because of the significant new debt Walker Dunlop took to acquire Align Capital. Other operating expenses was much higher than 1 year ago, but it's comparable sequentially to first quarter of this year and the fourth quarter of last year. That's because of in 1 year ago, the business was still impacted by COVID, so the travel and the entertainment expenses were suppressed by the pandemic. Now it has normalized. Now let's take a look at the EBITDA. So the second quarter EBITDA was $95 million compared to $67 million 1 year ago. The significant increase was because of Walker Dunlop had a fairly strong cash generating business, including the mortgage service fee, as well as investment management fee and consulting fees. Those are not based on transaction volume and as a result not very sensitive to the interest rate environment. Of course, that increase need to be put in context of significantly more debt and higher interest payment. So in this year, I forecast Walker Dunlop will pay about $26 million in interest, compared to about $8 million in previous years. So because of the additional debt, the best measure of valuation is enterprise value over EBITDA. So that's about 14.7 at $114 per share. That's using 2021 EBITDA of $309 million. The management gave an outlook of a double-digit EBITDA growth in this year. That will lower the EV over EBITDA ratio to less than 14. Ingredion also had a pretty good quarter too. Its second quarter revenue was over $2 billion, 16% increase year over year, despite the foreign exchange rate headwind. Its gross margin 19.1%. It's very decent compared to 1 year ago 20.8% in a very different inflationary environment. As a result, its adjusted operation income was $215 million. That's actually higher than all the previous quarters. Its cash from operations in the second quarter was $48 million. That's because of working capital impact reduced CFFO by $164 million. The good news is the management gave a full-year guidance of a CFFO coming around $330 million. That means in the second half of this year, the working capital impact should be negligible. Its stock is reasonably priced at $94 per share. That gives a PE ratio about 13. Mercado Libre also reported a very strong quarter. So in the second quarter, there were 84.3 million active users, up 11%. Its e-commerce segment now contributed 54% of revenue. Its growth was pretty decent, but the revenue percentage reduction was because of even stronger growth in its fintech business. Now that's about 46% of its revenue. That business is driven by very strong payment volume growth off its platform. So that's experienced 70% of its total payment volume. And the unique fintech users also grew 26% from 1 year ago. So you can see that the second quarter revenue was about $2.6 billion. That's a 57% growth from 1 year ago. That's not as high as previous quarters, but 57% is extremely high considering that the previous quarters were helped by the pandemic. Another good news is the gross margin was also improving to 49.4% compared to 44.3% 1 year ago. I believe the higher gross margin was mostly driven by the increase of fintech business as well as operational leverage from efficient use of its logistics network. So the second quarter fintech sales was about 1.2 billion. That mostly come from two areas. One is related to the fee from payments. We can see in the top graph that in the latest quarter, the total payment volume was over $30 billion. The acquiring payment volume was related to commerce, including its e-commerce segment. And the digital account was related to just outside the commerce, for example, person-to-person and credit and investment management. We can see that the digital account, the total payment volume was $9.4 billion in the latest quarter. That compares to $3.3 billion in the third quarter of 2020. That's almost triple. For the acquiring TPV, the volume was 20.8 billion in the latest quarter, compared to 11.3 billion in the Q3 2020. That's almost double. So both segments were growing very, very fast, but the digital account TPV was just growing gangbusters. I believe a key driver behind it is its explosive credit growth. As shown in the bottom left chart, its credit portfolio in the latest quarter stood at $2.6 billion, compared to less than $300 million in the Q3 2020. That's more than a factor of 10. So its credit revenue now is about 44% of its total fintech revenue. Then the key question is Mercado Libre just lower its credit standard and taking on excessive credit risk to grow its credit portfolio? If that's the case, then the default rates will go up, and it may end up losing money despite its very fast-growing credit portfolio. So the company actually gave quite a bit information about the non-performing loans. That's shown in the middle bottom, the two lines with the orange color. So for loans 90 days past due, the latest quarter was 18.2%, compared to about 14% in the previous 2 quarters. And for loans 30 days past due, that's 25.3% in the latest quarter, compared to 21 and 19% in the previous 2 quarters. So the non-performing loans were increasing, and that can be concerning. However, the management also provided information about the interest margin after losses, IMAL. That's shown in the graph at the bottom right. So each column shows the total revenue from credit that includes interest payment as well as late fees. For example, in the most recent quarter, that revenue was $529 million. However, not all the loans are recoverable. Some loans go into default and get written off. That's shown as the gray columns inside each quarterly column. So we see, for example, $304 million of loan write-off in the most recent quarter. So the blue area, $225 million, that's the interest margin after losses. The point of this graph is to show that this IMAL has been growing sequentially in the last several quarters in consistent growth with the credit portfolio growth. For example, the IMAL was $81 million 1 year ago. Now it's $225 million. So despite the increased loan losses, the IMAL was actually increasing sequentially. I guess the point is as long as the IMAL is growing, the company is managing its credit portfolio and making it a profitable business. Because IMAL and default rates are very sensitive to the macroeconomic environment. So this is something need to be monitored to make sure the company is not taking too much risk. Lastly, just a quick update on the valuation. At about $1,000 per share, its price over sales ratio is about 6 compared to 14 for Amazon.com before pandemic. The company is like a combination of Amazon and PayPal and American Express without the AWS. That makes it a little hard to use the price over sales ratio to compare between the two companies. Finally, just a quick update on the take rates. For the commerce take rate, it was stable at 16.4% in the latest quarter. For the fintech take rate, it increased to 3.95% compared to 3.2% from 1 year ago. The increase was mostly driven by the significant contribution of credit revenues. In other words, the credit business has a higher take rate. It should be okay as long as the company is managing its credit portfolio prudently. Nevertheless, it's something to keep monitoring and be mindful of the macroeconomic environment and its impact on the credit risk. This concludes the latest episode of Quest for Twice. Until next time, happy investing.